Today's topic. First, let's check out how legendary trader Mark Minervini stays cool as a cucumber even in the wildest markets. Then, we'll preview some upcoming earnings from next week's headline makers. In the EV arena, it's East vs. West, BYD vs. Tesla. In telecom, we've got a three-way battle: T-Mobile, AT&T, and Verizon. And finally, meet the heavy hitter of defense, Raytheon Technologies, the muscle man of the military-industrial world. Mark Minervini, surviving chaos with low risk, high discipline. In a recent interview, legendary trader Mark Minervini shared his insights on today's turbulent market and how he's navigating it. He pinpointed April 7th as a potentially important short-term low. But is it the bottom? Too early to tell. We usually only see these types of sharp rebounds during extreme fear, like the '87 crash, the 2008 meltdown, or the 2020 pandemic panic. It's rare and worth watching. Despite the rebound, Mark himself is staying cautious. "I'm not a fan of super volatile markets. I'm a low-risk trader. I like those clean lockout rallies where once it breaks out, it just keeps going with barely any pullback. That's my sweet spot." He emphasized how unpredictable the market is right now, especially with policy headlines dominating, like Trump's latest comments on tariffs. "Right now, I'm 100% in cash." Yep, Mark has fully exited his positions, sitting on the sidelines. He admits he often exits early, but that's part of his style. "I focus on keeping drawdowns as small as possible. People love to chase tops and bottoms. I'm more about risk control. I'd rather miss out than get caught in chaos." This cautious approach helps him stay level-headed. He's not greedy, just waiting for the right setup. Consistent profits beat big home runs. Mark shared his top trade of the year, ALK. While the market was sliding, this stock held firm. After a surprise earnings pop, he sold for a tidy 25% gain. In this kind of market, a solid 20-30 gain. "I'm more than happy." He's also moved away from trying to nail the big one and now focuses more on swing trading with a solid strategy and tight risk control. Mark's advice for beginners. He's written 4 books, and his advice is clear. Don't worry about which one to start with, just read any of them 10 times. Seriously, 10, 20, even 30 times. Why? Because one read doesn't cut it. Real learning happens through repetition and applying the knowledge. Trading isn't something you learn from a single read. You've got to live with it. And his 3 golden rules for newbies. 1. Passion is everything. If you're only in it for the money, you probably won't last. Passion gets you through the rough patches. 2. Find a mentor. Stick with one method and go deep. Don't jump from system to system. 3. Early failure is a blessing. It's better to lose money when your account is small. That's how you develop respect for the market and learn the hard lessons early. That's Mark, a champion trader who puts risk control and discipline first. His style isn't flashy, but it's helped him survive and thrive in every storm. Next up, earnings preview: Tesla, T-Mobile, and Raytheon. Let's start with the biggest popcorn stock of all, Tesla. Tesla breakout or breakdown. Tesla reports Q1 earnings on April 22nd. Forecasts call for EPS $0.44 down 2% YoY. Revenue $21.87 billion, up 3. Sounds all right? Not so fast. Q1 deliveries were a big disappointment, the worst in over 2 years. All eyes are on 2 things. 1. Will the robotaxi dream come true in June? 2. And what's really going on with the so-called budget car project, which may just be a barebones Model Y with cloth seats and a tiny battery? Also, a major headwind, the US is slapping a 145% tariff on Chinese EV batteries, which Tesla heavily depends on for its energy division. To put it plainly, Tesla's having a rough patch, and let's not forget the PR landmine. Musk's ongoing political drama is hurting the brand image in the US and Europe. Investors are starting to wonder, should Elon tone it down? While 2025 delivery forecasts once screamed 20-30 growth, those expectations are quietly being downgraded. Tesla's high valuation depends not on car sales but on moonshot ideas, robotaxis, Optimus robots, full autonomy. But if these tech dreams keep getting delayed, trouble ahead. And speaking of robots, remember that humanoid bot Optimus? It looked like a cartoon transformer. But experts question, can it climb stairs? Carry loads? Or is it just a $200,000 mascot? Chart check, still not pretty. Tesla's stock has been sliding since January. It's far below the key 50-day moving average, struggling to gain altitude. Picture this, investors who bought high last year are praying for a rebound so they can just break even. For Tesla to win back traders, it'll need to break above the 20, 50, and ideally the 200-day lines. Fundamentals, also a bit messy. Last quarter's decent numbers? Mostly thanks to Bitcoin gains. Yes, Tesla still holds crypto and booked paper profits, but real earnings? Declining. Margins have shrunk over the past 2 years. If that trend continues, one has to ask, what's left to drive growth? Autopilot? Delayed. New models? Not ready. China? Intense competition from BYD, Li Auto, and Spang. Energy storage? Tariff headache. In short, Tesla's fundamentals aren't rosy. Faith and hype are doing most of the heavy lifting. Meanwhile, BYD is gaining steam. BYD reports on April 23rd, a day after Tesla, things are looking up for them. Sales are booming. Profits may have doubled in Q1. They don't rely on government subsidies to stay profitable. Overseas markets? Gaining traction. BYD might even outprofit Tesla in Q1, imagine that. But keep in mind, investing in Chinese companies comes with its own set of risks: policy shifts, geopolitical tensions, and sentiment swings. Summary: EV battle royale. Tesla is in a tough spot, hoping for a turnaround based on tech dreams and Elon's charisma. BYD is rising fast, with real profits and market share gains. Think of them as the West's old king vs. the East's rising star. If you're building an EV duo, Tesla equals long-term potential plus innovation. BYD equals short-term performance plus cost efficiency. Telecom's three-way showdown: T-Mobile vs. AT&T vs. Verizon. Why watch T-Mobile? Because it's not just another boring telecom, it's the fit and flashy one of the bunch. T-Mobile reports on April 24th, and earnings are expected to jump 23% with flat revenue. What makes it stand out? While AT&T and Verizon push bundled services, fiber plus wireless, T-Mobile wins with strong user growth and better service. Last quarter was a record breaker for customer additions, both postpaid and prepaid, technically looking strong, holding above the 50-day line. Relative strength at new highs. Chart says ready to pop if the broader market cooperates. AT&T and Verizon, the other two. Verizon, the dividend dad of the trio. Stable cash flow, great for income seekers but not much growth. It was doing okay until management spooked investors with vague guidance. AT&T, the warming up underdog, charts improving, above the 20-day line, decent strength, but the long-term trend still lacks conviction. Think of it as a good backup, not the star. Summary: telecom trio. T-Mobile, growth play, strong chart, great momentum, but low dividend. Verizon, stable income, low growth, safe but sleepy. AT&T, recent rebound, still a work in progress, has potential but needs follow-through. Raytheon, the defense giant with firepower and a headache. Raytheon makes missiles for jets and engines for planes. Earnings come out April 23. Forecast: EPs up 13%, revenue up 10%. Sounds solid, right? Especially in a world where geopolitical tension equals more defense orders. But here's the catch. Raytheon's engine division, Pratt & Whitney, had a big problem last year: a metal powder defect in its GTF engines. That's a major safety concern. So they had to issue recalls and inspections, costing big bucks and spooking investors. Why didn't you tell us earlier? Said everyone. So while Raytheon's defense side is steady, this engine scandal has clouded sentiment. Chart: not bad, not great. Raytheon's in a cup pattern, but it's not a clean breakout setup yet, still below its ideal buy point. Relative strength improving, but hasn't fully broken out. Technicals equals watch list, not a screaming buy yet. If you're a momentum trader, you might pass. If you like value hunting and mean reversion, it's worth watching. Raytheon's investment case: defense orders equals stable. Aerospace equals recovering, but engine issues need time. Valuation equals reasonable, not hyped like AI stocks. Raytheon is like an injured athlete in rehab, used to be a beast, now slowly recovering. You want to watch his training, but don't expect him to sprint just yet. Wrap up: Mark Minervini shows us how to survive chaos with low risk and strict discipline. Tesla vs. BYD, the EV showdown: faith-based growth vs. profit-driven performance. T-Mobile, AT&T, Verizon, the telecom triangle, each with its own style. Raytheon, the recovering warrior of defense and aerospace. If you enjoyed this video, don't forget to subscribe, give us a thumbs up, and ring that bell so you don't miss more spicy insights.